All right, so we're here with Andy Rachleff, and would you mind introducing yourself to the audience?
Sure. My name is Andy Rachleff. I worked in venture capital for 25 years, the last 10 of which were with Benchmark Capital, which I co-founded and was a general partner at. Since then, I have been on the faculty at Stanford Graduate School of Business, where I've been teaching for the last 17 years. And I co-founded a company called Wealthfront, where I am now the executive chairman.
And you told me that you coined the term product market fit, so can you tell me about that?
Sure. I always wanted to get better as a venture capitalist, and one of the things that I noticed through my career, that success was far more a function of the quality of the insight and how strongly the market reacted to it than it was the execution of the management team.
Yeah, you have a good quote. It's like when lousy entrepreneur meets lousy market wins. Is that correct?
Well, it's when bad management meets a great market
Okay.
wins.
Yeah.
When great management meets a bad market wins.
Mm-hmm.
And when great management meets a great market, something special happens.
That's right. That's right. I like that. I've always liked that one. So let's get into the meat of the video, which is, what is venture capital in your words?
Well, very simply stated, it is the business of providing capital to entrepreneurs to help grow their private businesses.
Okay. How do you guys make money? How does a venture capital firm make money? Because it seems a little bit like a black box to me. You guys definitely raise a lot of money from your LPs, your investors, and then you fund these startups. But how does the venture capital, what are the different types of economics that they can go through to make money themselves?
Sure. Well, a venture capitalist makes money in two ways: a management fee and what's known as a carried interest.
Mm-hmm.
Let me explain the two. So that the way a venture capital firm is organized is through the management of funds. So they'll raise a fund, say $500 million. That fund, they raise that money from institutional limited partners or investors. The fund usually has a life of on the order of 10 to 12 years. So the representation by the venture capitalist is that they will return all of the capital in 10 to 12 years. The fund pays a management fee of approximately 2% a year.
Mm-hmm.
So if it's a $500 million fund, that's approximately $10 million a year. That money is used to pay the salaries of all of the people in the firm and to pay for all of their overhead, travel, entertainment, consultants, you name it, due diligence expenses. On top of that, the real money is made through what's known as a carried interest. This is a percentage of the profit. On average, the percentage of the profit the venture capitalist keeps is 20%. So imagine a venture capital firm invests $10 million in a company, and it grows to be worth $110 million.
Okay.
That's $100 million profit on the investment. 20% of that is $20 million. So of the $110 million of value, 20 goes to the general partners of the venture capital firm,
Mm-hmm.
90 million goes to the limited partners.
Interesting. Okay. So how does the math work when, say, the venture capital fund comes in at like a Series A, gets 10% equity in the company? The 10% of that equity in that company, it does become 100 million. That's the profit you're talking about?
It's whatever the ownership turns into. At what price do you liquidate those holdings?
Okay, understood. This may seem like a naive question. What does a venture capitalist do day to day? What are they looking to do?
Well, there are two functions. One is finding investments, and the other one is working with investments. Most people confuse or glorify the business to be consulting for early stage technology companies. That's actually a small part of what we do. The big part of what we do, most of the value added, is in finding and choosing investments. So you have to kiss a lot of frogs to find a prince. So you meet with a lot of companies. The average venture capitalist makes on the order of 2 investments per year. You might meet 300 or 400 companies to choose those 2 investments per year. And then on top of the time you spend trying to find investments, you generally join the board of directors of the companies in which you invest. If you're an early stage venture investor, if you're a late stage, you don't. But if you're an early stage venture investor, you join the board of directors with the intent of trying to help that company and increase the odds that it's going to be successful. And that generally takes up about 50% of your time.
So 2 VC deals a year is what one venture capitalist would look to do, or one firm would look to do?
One individual partner.
Got it.
So if the firm has 6 partners, they
12.
might make a dozen investments per year.
And do you guys confer with each other about which deals the firm will do together? For example, you bring a deal to the table, you present it to the other GPs, general partners. Can they veto your deal?
Sure. So different firms have different methodologies by which they make these decisions. Most firms choose based on a consensus basis. So they want everyone to buy in to make the investment. Other firms, like my old firm, Benchmark Capital, operates on a voting system where the majority rules.
So as long as you had quorum, it was good.
Well, but it depends. The way we had a voting system, and still do, where every partner has to vote on a scale of 0 to 10. You can't vote 5.
Oh, interesting.
And in order for an investment to get done, a majority of the partners have to vote in excess of 5. Now, if the majority all vote 6, that's a weak mandate. So it's up to the champion to decide whether or not they want to act on that mandate. They have the right to, but they don't always do it.
They don't always do that.
Because there's signal in the voting.
Cool, I like that. Can you describe the differences between the different series? So series A, B, C, D. What's the different series that, what are the different stages that the company is in that would warrant the series A versus the series B versus the series C, and what size is that check usually?
So venture capitalists don't invest all of the money that the company will ever need at once in order to do a better job of mitigating risks. So the idea is that we give you enough money to get a stair-step decrease in risk.
Okay.
And then the company will raise money again, hopefully from us and other people. You want someone new in order to have an objective view of how the company is doing. If we can't convince an outsider to invest, then that's a bad sign. So at Benchmark, we always felt it necessary to get a new investor in every round to prove that objectively the company is worth financing. So at each round, there's hopefully a stair-step decrease in risk. So traditionally, a company initially raises what's known as a seed round. They typically do this from angel investors, and that money is used to prove what's typically known as the value hypothesis. It's the what, the who, and the how. What are you going to build? For whom is it relevant? And what's the business model associated with it? So if you can prove that people will buy into that value proposition in terms of business momentum, then you can typically raise what's known as a Series A investment. You typically do that from an early stage venture capitalist. Once you prove the next stage, the next thing that needs to be proven is the growth hypothesis. Can you acquire customers at a cost-effective price?
Okay.
Once you prove that, then you're on to a Series C. The Series C is usually raised in order to scale the business. So you know the dogs want to eat the dog food from proving the value proposition or the value hypothesis. You know you can acquire them cost effectively. The Series C gives you a lot more capital to acquire them. And then you might need more capital even beyond that to accelerate the business if it's going well, and that might be a Series D.
Where does product market fit into those? Seed?
Well,
or Series A maybe?
Well, to me, proof of value hypothesis or the value proposition is product market fit.
Got it.
If people want to buy if you figured out the audience that's desperate for your product as it currently exists, that's product market fit. So that should be proven before the Series A. And that's why a lot of companies do what are known as seed extensions, where they'll go back to their seed investors and ask for more money because they're unlikely to get venture capitalists to put up a Series A.
Let's talk about the angel investing thing. You've told me in the past that the average person should not angel invest.
Correct.
Is that correct? Why is that?
Well, if you look at the statistics on venture capital investing, approximately 3% of the firms, 20 total firms in the United States, generate about 95% of the realized returns of the industry. Talk about Pareto optimized.
Yeah, seriously.
So
okay.
a very small cohort, which persists, generally persists year in and year out, generates the vast majority of the realized profits. Now, I'm not talking about just
on paper profits.
on paper profits. I mean realize that you've sold the stock through IPO or through the sale of the company.
Mm-hmm.
Well, if only 2 or 3% of the venture capital firms generate 95% of the returns, that says that the vast majority of people who do this for a living aren't very good.
Mm-hmm.
So what makes you think that on this, as a side hustle, that you're going to do very well when the vast, vast majority of people who do this professionally don't do it well?
I think it's kind of anecdotal. You know, people see the guy who invested $25K in Uber, right? And
so
hit a
you
home
can
run.
get lucky.
You can get lucky, but it's kind of like a gambler's fallacy almost in a way, right?
Exactly. It's like a fishing story.
So let's backtrack a second and let's try to explain to maybe who's watching, what is the difference between angel investing and venture capital?
Sure. Well, an angel, the name originally comes from people who gave money for Broadway shows. They were angels.
Okay.
And so they helped people achieve their dreams of starting the show. And so I think that was carried over into the entrepreneurship world. And the whole idea was to help an entrepreneur get started, not necessarily to make a lot of money. You were helping out your friends.
Yeah.
Now, that's evolved and it's become more institutionalized. But angels don't contribute very much to the company beyond the capital that they provide.
Right.
They don't have time. They typically have they have a full-time job and other things to do. In contrast, a venture capital firm has been well-funded. We talked about the management fee that allows them to be well-staffed and to get access to all of the resources you need. And hopefully those resources can be brought to bear to accelerate the business. Now, there are misunderstandings about venture capitalists that they want to tell you what to do. That might be true of poor venture capitalists, but the good venture capitalists never do that. The good venture capitalists are there to help you with your problems when you come to them. And I think Mike Moritz from Sequoia Capital, who used to be the managing partner, would say that at Sequoia, we are always one call away from the ideal person to answer your question. So the venture capitalists might not have the answers, but they have the network that helps you get to the people who are ideally suited to help you with your problem.
Okay, that makes sense. For the people that are watching, there are a lot of people, younger people, that want to get into venture capital, but they have no idea how, and they have no idea why, by the way. They just view it as like this industry where you can make a lot of money. Can you debunk that a little bit, and maybe could you talk about what the process would be to work for a venture capital firm if they really wanted to?
Well, it's hard to make a lot of money if you don't work for one of those 20 firms, the
Right.
3% of firms that generate all of the returns. The way to get noticed by those firms is to be successful. Now, there is a misunderstanding among people that venture capital firms prefer to hire people with operating backgrounds, which is true,
Okay.
but that they prefer to hire them for their operating skills. Nothing could be further from the truth based on what I just told you, that if a venture capitalist uses his or her operating skills, we're in a lot of trouble, because you back entrepreneurs and management teams, because they should know their business better than we can, because we're investors in anywhere from 6 to 10 companies, and this is all they do. So the reason that venture capital firms like to recruit people with operating backgrounds is that, all things being equal, the biggest difference in returns among venture capitalists is the quality of their network. If you fish in a better pond than I do, you're likely to catch more fish.
Okay.
If I have a better network than you have of high quality people, I'm more likely to find good deals. And all things being equal, if I have access to more good deals, I'm going to do better. Judgment, no matter if you have better judgment than I, if I fish in a better pond, I'm going to do better. Well, if you've had a successful operating career, then the odds are that you were heavily recruited, because if you work at a successful company, people try to bring you into their company.
Right.
That's a proxy for network. And if you've been successful, people probably search you out for advice. That's a great proxy for network.
Right, that makes
So
sense.
all things being equal, the people who are generally in the best position to have the best network are people who've had a lot of operating success. So I've actually published a book on this called the Wealthfront Career Launching, or Silicon Valley Career Guide, that talks about how do you build your career for success, to increase the likelihood of success.
So if you see someone that's straight out of college and they're like, I want to be a venture capitalist, do you just kind of laugh and you're just like, go get some experience, kid? Or
Well, sure, they don't have a network yet, so they're not yet ready to be a venture capitalist. So how do they generate the success that's likely to attract a network
Exactly.
that will then attract a venture capital firm?
Okay.
And
Makes
that's what
sense.
I explain in the
book.
book. It's only 20 pages, so don't be
Okay,
intimidated.
I gotta check that out after this. Let's talk about some of the terms you might pay attention to on a term sheet. So first, let's explain what a term sheet is, and then maybe some of the terms. I mean, I have 9 terms written down, which we can go through. But what
I'll
are the
save you the time.
Okay.
So
Hit me.
unlike investing in the public market where you buy common stock, in the venture capital and angel market, you typically buy something known as convertible preferred stock. Now, all things being equal, it'd be a lot easier to just buy common stock in companies. But about 50 years ago, a really smart attorney came up with this brilliant idea. And that was, if we sell the venture capitalist a different security that is perceived to have more value than common stock, then we can sell common stock to employees at a much lower price and offer stock options with an exercise price much, much lower. Now, when this attorney came up with this idea, you were able to price stock options at 1/10 the price of the preferred stock.
Okay.
In order to justify this to the IRS, and it's the IRS that had to buy into the fact that there was a difference in the value, so that people who got common stock weren't taxed on the difference between the value of the common stock and the preferred stock, you had to show value. So he came up with all of these terms that were perceived to have value, but didn't really have value. For example, the preferred stock had a dividend, when and if declared, but the board would never declare the dividend. Number 2, it had something known as liquidation preference, which meant that if a company liquidated for a value below the total amount of capital raised in preferred stock, all of the proceeds would go to the preferred investors. Well, you can't make money in a venture capital firm by focusing on getting half your money back or 1 times your money back. All the money is made on big winners, on 10 or 20x winners. So it almost doesn't matter if you get 0 back or 1 times your money back. So it's a complete worthless term.
Okay.
But people perceive value in it, especially people from the financial world, which always cracks me up. Then there are voting rights, which again have never come to play. So there are a bunch of terms that you're going to ask me about that are really irrelevant. Unfortunately, about 20 years ago, a bunch of people from Wall Street started getting into the venture capital business, and they saw this security with terms, so they thought, let's negotiate the terms as though that was a way to make money. In my entire career and since observing the venture capital world, I've never seen anyone make money on the terms. The only thing you make money on is the appreciation of the security.
Okay. So if you do get a term sheet, you're not even worried about any of those things on there.
Not really.
That's such a different philosophy than
What
all the
matters-
YouTube videos that I just watched on venture capital.
Because the people who do those videos are not experienced venture capitalists.
I love that. I love that. Yeah, I literally just watched a lecture where the person goes over at Stanford, goes
It
over
doesn't matter if they're from Stanford.
pro rata, drag along, no shop agreements, protective provisions.
All
right
of these are irrelevant.
irrelevant.
So the joke among attorneys is you always know an attorney who doesn't know what they're doing when they negotiate registration rights, which is another one of the terms.
So
Which is what junior attorneys tend to do.
So what do you pay attention to?
The price.
Just the price, that's it.
Actually, the thing that matters more is the quality of the business.
Okay,
So turning a company down on price is always an enormous mistake,
okay.
because the best companies are always too expensive. From the time they're started to before they go public to after they go
Interesting.
public. They're always overvalued.
Okay.
So the thing that matters more than anything is getting involved with a company that has a chance to become very large.
It's that
Of
simple.
it's that simple.
that simple.
And of secondary interest is the price.
Got it.
And after that, almost nothing matters.
Tell me the difference between a firm like Benchmark versus a firm like A16Z, Andreessen Horowitz. I know that they have a lot of people that work at A16Z. What is the difference between the structures there?
Well, they're radically different. The biggest difference, perhaps, is the offering of services. So,
Okay.
Andreessen Horowitz offers a wide variety of services to their portfolio companies. They offer recruiting help, they offer help with venture leasing, they offer help with public relations, all sorts of services, and Benchmark doesn't do any of that.
So it's almost like full suite versus Benchmark, just advisory.
The question is, how valuable are
How
those
valuable is
services
it?
really?
Right. Are they?
I'm not going to comment.
No comments.
Because I'm friends with people.
I know.
I helped, I was a founder of
Good.
Benchmark, and I helped Ben and Mark get started, so.
Understood. Which VC firm do you regard as the best these days? And how has the landscape changed from when you started and now?
Sure. Well, I think that the two firms that are generally held out to be the best are Benchmark and Sequoia. And I think that's been the case for quite some time. When we got started, Kleiner Perkins was perceived to be the premier firm by quite a margin. So things have changed a lot.
Has VC changed at all from, let's say, the 90s till now?
Radically.
And in what ways?
Well, the biggest way is that when in the 90s, and when I was sort of at the height of my career, venture capital firms invested in companies with high technical risk and low market risk. If you really could build what you said you could, you knew people would buy the product, thus low market risk. Well, those were primarily hardware projects.
Okay.
So we spent all of our time trying to determine whether or not the company could actually deliver on what it said, which was usually an architectural innovation. Fast forward 10 years, everything becomes software, very low technical risk, very high market risk. So you know that people can build what they say they can. The question is, does anybody want them? How do you know if somebody is going to want to stay in somebody's room on an air mattress? How do you know somebody is going to be willing to let somebody drive them around?
So now more than ever, market is way more important.
Well, market is a bigger risk.
Okay.
It's always been very important. So success or failure of companies has always been a function of whether or not the market wanted the product, not the execution. Well, market has always been the biggest risk. So market risk is far greater at startup today than it was previously.
Got it.
The way that the premier venture capital firms reacted to this was by outsourcing the initial rounds to angel investors. So they realized that that was a really, really, really bad risk-adjusted return.
What was?
Investing in the raw startup of a company
Right. So
that
now
had
it's
low
just-
technical risk, high market risk.
Now it's just angels.
So now the angels think they wanted away from the venture firms, but they were suckers. They took on this thing, had horrible risk-adjusted returns. And then what the premier venture firms did was said, we'll let the angels take all of this market risk, and we'll wait for companies to prove product market fit. We'll then come in and pay 3x to 10x the price, but on a risk-adjusted basis, that's radically better. So whereas 20 years ago or 30 years ago, we'd pay $5 million pre-money for two people, two entrepreneurs and a dog, and then the next round would be at 20 or 30 or 40 million dollars. Today, the angels invest at the $5 million valuation, and the venture capitalists invest at 25 to 50 million. Now, the number of companies today, the number of companies worth 500 million 30 years ago is comparable to the number of companies worth $5 billion today.
Oh, interesting.
So to get the same 20 to 30x return, there's dilution along the way from the $5 million valuation to 500 and from the 50 to 5 billion. It's the same number of companies, which is why you see the returns of the premier venture capital firms staying relatively constant, even though they're paying much higher prices than they used to. So it's much more growth equity than what we did 30 years ago.
Got it. Cool. What would you say the success rate is out of 10 investments or 100 investments?
That actually is not a relevant question.
That's not a relevant question.
Because,
Okay.
because the percentage that succeed doesn't matter. It's the magnitude of success when they do. In baseball terms, it's called slugging percentage versus batting average.
Okay.
So I would much rather invest in a firm as a limited partner that's right 2 out of 10 times, but when they're right, they make 30 times their money, than investing in a company that always succeeds but only makes 2 times their money on every single one. Because in the former, the fund is going to be 6x,
Right.
and in the latter, it's going to be 2x.
So you just care about magnitude.
I just care about magnitude.
Okay.
And that is not, and that it's not intuitive for the vast majority of people. This idea that it's the magnitude, not the percentage, is all that matters in venture capital. So when I hear people making fun of venture capitalists who've had losses, I immediately know that they don't know what they're talking about. As a matter of fact, when I taught a class on venture capital at Stanford Graduate School of Business, I used to ask my class, what do you call a venture capitalist who's never had a loss? And I would say unemployed, because I don't want them as a partner.
Yeah.
They're not, because the only way that you can avoid ever having a loss is not taking as much risk, so you don't get the big wins.
So I'm almost hearing that it sounds like you like a lot of risk.
Yes.
Interesting.
Without risk, there's no reward.
Yeah. But it's almost at an extreme point. It's like...
But you don't take risk for risk's sake.
Right.
You have to look for asymmetric risk.
Asymmetric risk. So
Meaning if you succeed, you
Right.
succeed big, but if you fail small.
What was the longest stretch of time where you just had no success in venture? Was there like a stretch of 10 years where you just didn't make any money, and then all of a sudden, year 11, boom, huge?
Well, there was a streak of about 3 or 4 years after the internet bubble burst where it was really, really hard. But it came back.
Okay. What's the worst pitch you've ever seen?
I can't even remember. Because I don't think about the bad. It's just like, I also don't think about investments that I made that went out of business, because I only lost 1 times my money.
Right.
What bothers me
Asymmetric.
more is the companies that I turned down that went on to success.
That's the next question. What's the company you passed on that you wish you didn't?
Cisco.
Ah. Tell me about that.
Well,
They came to you and they said,
they
hey, we
came
got
to
this
us,
great business.
and they actually were already shipping product and people were buying it, and I turned it down. and it went on to be one of the huge successes of the 1980s.
Why did you turn it down?
1990s. Well, they had very, very difficult founders.
And you bet on people.
And back then, I was much more likely to bet on people.
These days, not so much?
And the interesting thing is Sequoia, who never cares about people, they care about the product. I learned product market fit from them. I coined the term, but they came up, Don Valentine came up with the concept. He almost ignored the people. And so 60 firms turned Cisco down. Sequoia did it because they ignored the people and they looked at the product market fit.
Oh, interesting.
Which was an amazing lesson for me.
I like that lesson. What's the best deal you've done in terms of returns?
I don't even know because I don't measure it that way. I think of the most successful company.
Okay, what's the most successful company?
I've been really fortunate that I backed a number of companies that went on to build multi-billion-dollar businesses. But Equinix is a really successful one. America Online back in the day.
Really?
I funded that back in the 80s.
In the 80s?
In the 80s.
Jeez, okay. You ever watch that movie, You've Got Mail?
Yes.
Okay.
And then a number of successful companies in between, but a lot of them were infrastructure or plumbing companies, networking equipment companies that nobody ever knows about. So my kids always made fun of me because I never worked on the fun consumer-related companies.
Like what, like DoorDash or something, or?
Although DoorDash was started by one of my former students, and I was an angel investor in DoorDash.
Okay. Can you tell me about when you created Benchmark? Why did you create it? How did you start it? Tell me more about that, because it was started in 95, I read.
Correct.
And so you had already been working in venture capital
for 10 years.
10 years, okay. Why Benchmark?
Well, my previous firm had decided not to raise another fund. 2 of the 5 partners wanted to retire.
And were you a general partner?
And I was a general partner. So there were 3 remaining partners, and we had the choice of whether or not to take that franchise forward or to start with a clean sheet of paper. And there was another really great firm, another top 5 firm at the time called TVI, and they faced a similar issue. Their founding partner had just retired, and they declared victory, as they called it, meaning they decided to run the funds out, but they weren't going to raise another fund, and that made all of the partners free agents. So my partner Bruce Dunleavy and I at Merrill Pickard and a partner at TVI named Bob Cagle were all very focused on wanting to build a firm that could be number 1. And we both, all 3 of us, felt like there was cultural baggage from our previous platforms that would not allow us to achieve that. TVI, I think, was number 2 in the market, and we were probably number 5. But we didn't think we could take either one of those platforms to number 1, and we wanted to do something where we started with a clean sheet of paper. So we also had as a partner an amazing guy who we would have recruited as a partner to Merrill Pickard. He had been one of our entrepreneurs that Bruce Dunleavy had backed, named Kevin Harvey. And there was a 5th fellow who ended up leaving after about a year and a half. And the 5 of us started Benchmark because we wanted a shot of building the best firm in the business.
It's like assembling the Avengers. There you go. I want to shift the conversation. Well, there's only a few more questions.
Sure.
But I want to know what your opinion is on influencer businesses. So I know that they're more consumer-based, but influencers these days, they're creating their own brands and they're creating their own businesses. And because of their reach, they're able to subsidize CAC, or cost of acquisition. And I was listening to a podcast with Jason, I can't say his last name. Calacanis. I always think it's Kalinakis, but Calacanis, and he was saying that in the future, or maybe someone on the pod was saying in the future, 30 years from now, you're going to see a lot of influencer-based businesses take over traditional businesses because they have the reach and they won't have to pay for customer acquisition, versus the traditional consumer brands will have to pay for acquisition and they're getting killed. Do you have an opinion on that? Do you think that's true?
Well, I think there's a question as to whether or not influencers are a channel or a vendor. So I think some influencers are backwards integrating so they can become a vendor. But I don't think that is a common strategy.
What would backwards integrating mean?
Where you create the product.
So like Kim Kardashian creating Skims or whatever her underwear product, right? Would that be backward integrating?
Yes, if she actually is responsible for designing and manufacturing the product as well.
So now she has the vendor capability, but also the channel.
But the question is, how many influencers are in a position to do that? Number
Not many.
one.
Yeah.
Number two, I worry about companies whose only advantage is brand.
Makes sense.
Glossier,
it has to be a good product.
I mean, well, you have to, the reason that venture capital works in technology and not in other areas is the basic premise that you're replacing capital with intellectual property.
Right.
So, for example, when SoftBank created a strategy of funding companies that needed the most capital, that made no sense to me because it defied all of the logic I was ever taught. That you're trying to fund companies that don't need capital because of intellectual property.
Okay. Understood.
So I think it's unlikely that influencers will create businesses that are built on an insight created around an intellectual property insight.
So from what I'm hearing from you, it's almost like they can maybe differentiate based on brand, but only for a shorter period of time until something better with intellectual property might come along and displace it.
Correct.
Okay.
And I bet on intellectual property over brand
any day.
That's how I made my career.
Okay, I like that. Last question. Actually, last statement.
But that doesn't mean that an influencer there can't be outliers. With whatever answer I give to you, it's never absolute.
Never black and white.
It's never black and white. There's always outliers.
Do you have any advice for aspiring entrepreneurs that are out there right now?
In what regard?
Either mindset, how you live your life, work ethic, what to work on.
See, I think none of those matters.
None of those matter.
So the typical
Just
advice
blowing my mind over here.
The advice that people give about all those things mattering, I couldn't disagree with more. I think that they might be true in non-technology businesses, and I can only intelligently comment on technology businesses because that's the only area that I've lived in and worked in. But the key to success in the technology world is the insight, is having a unique insight that could then be turned into a product that people are desperate for. And so if you look at the vast majority of technology companies, again, there are outliers, but the vast majority of technology companies are the result of an entrepreneur recognizing an inflection point in technology and realizing that that can enable them to build a product. Then the question then becomes, does anyone want that product? And they typically have to iterate on markets before they find one that actually wants that product. Now, once they become successful, they revise history and make it sound like they set out to solve a problem in a market. That's not what they did. They started out with a product looking for a problem, but it was based on an inflection point in technology because without change, there's seldom opportunity.
Okay, understood.
So you don't have to be all that motivated. You don't have to be all that great at managing. If you come up with one of these insights,
that's it. I guess
how else can you explain a 25-year-old running a $500 million revenue or $1 billion revenue business? They don't know how to run that.
No.
But their insight was so powerful and served such a desperate audience that people pulled the product out of their hands.
Got it. I guess that question was more geared towards, like, let's say your son comes to you and your son says, hey Dad, I'm just having a hard time figuring out what to do with my life.
I would never tell him start a company unless he has a killer insight. So people come to me all the time and say, I'm ready to start a company. And I look at them, why does that matter? The fact that you're ready or that you can take risk is absolutely irrelevant if you don't have a killer insight.
I'm trying to take you outside of the starting the company thing. I'm just trying to ask for, like, you know, if your son was really upset and just wanted, you know, what would you console him with?
Well, first,
What
I would
you
hug
work
him.
Like,
But we talk about this all the time.
yeah.
But I think he's actually following the advice that I gave in that book that I recommended earlier,
Okay.
the Silicon Valley Career Guide. And he's witnessed all of my students who followed it, go on to great success.
Okay, I got to read
And so
it now.
he's basically following the advice of that book. So he's works at an incredibly successful company called Databricks. He's been there for over 4 years now. He'll probably go. He then would probably seek, if he were to leave, seek out another early stage company, post product market fit, that's doing very well. And if an insight hits him at some point in his life, then he might be in a position to start a company. And if he doesn't,
It's okay.
it's totally fine. Like, I don't think more of him for having started a company.
All right. Well, Andy, thank you for your time. Thanks
Always a pleasure.
Thanks for sharing with us your wisdom.
My pleasure.
I think that's it.
Cool.
How are we on time on there?
20 minutes exactly.
Perfect.